David, you often remind us that the bond market is massively larger than the stock market. Here's a Yahoo Finance headline: investors grapple with bond chaos in aftermath of President Trump's Liberation Day. What's happening in the bond markets?
Well, so the bond market has been in a downtrend for the last several months. However, in the recent just week, we've seen a reversal in yields. And in fact, we saw something earlier this week. I believe it was Monday. You saw bond yields go from on the 10-year Treasury negative 13 on the day to a positive like 13. That's only happened 3 times in history. That's a massive move in one day for it to be negative that big, double-digit basis points, and go positive.
That doesn't happen in the bond markets.
No, and so what happens is, remember, when yields are going up, bond prices are going down. So that means people are losing money if they own the bonds, if they sell them. Of course, if you hold it to maturity, you're not. But so we've seen a massive rally back up in yields, which means bonds are losing money. So what's going on? Some people are like, China's dumping all their bonds. And I don't have it for this week, but next week I will have a chart up showing you who actually owns U.S. Treasuries. And China is not the largest. People think, oh, China owns all our debt. They're not even in the top 3, okay? Japan owns more of our debt than China, believe it or not, a much smaller nation. But China owns less than $760 billion of U.S. Treasuries. They're not even close to $1 trillion. But anyway, that's for another story for another day. For today, I just want to focus on understanding why are the yields skyrocketing. Well, you have something unwinding in the hedge fund space right now where they are getting clobbered. And because they made a very large leveraged bet, as hedge funds will do. Ironically, hedge funds don't hedge, Chip. They lever. Just the opposite of hedging, okay? So what they're doing is they bought U.S. Treasuries, and then they short the U.S. Treasury in the future market using the Treasury as collateral, and they can leverage that. You can go up to 200 times in the future market. Now, their average is like 21 times leverage. So if they bought $100 billion of Treasuries, they can lever that up to $2 trillion of Treasury shorting. And when the yields went up, those futures, they lost money, and they had to cover. And to cover, they have to sell those Treasuries at the open market because there's margin calls coming all over the place. That is what put the selling pressure on Treasury, at least what I've uncovered thus far this week. And that's why yields went basically from, we were at 3.9 last week to 4.5 as of Wednesday's opening. That's a massive, massive move in the yield. But it doesn't mean the overall trend down on yields is over. But again, this is where speculators are getting, what handed to them versus long-term investors. You need to understand the difference. Are you a trader? Are you an investor? I have a very good friend who's a trader, but he likes to talk to me like he's an investor. I'm like, you've never owned anything more than 3 weeks in your life. You are not an investor. So stop joking like you are. But you need to understand the difference of how you're making decisions. And I can't say this enough, Chip. People are making long-term decisions with short-term data, and that's bad, right? You correlate what the data is to the decision and the time frame when you're making these important decisions.